Admit. Feel free to keep your camera on if you want. We're going to try to keep this as interactive as possible. I know it's hard to do a Zoom meeting interactive and not being at a restaurant to do this meetup group, but we're going to do our best. We're going to try to have a lot of fun. Ian, you good on your end?
Yeah, I'm trying to spin tunes. It's not really working.
Either
way, people are coming in the door, trying to share everything. We're going to have a real fun, interactive one tonight.
So, yeah, I'll keep adding everybody. I know everyone's kind of hopping on right at this time. Let's give it one more minute. We'll get started.
I see a couple of the special guests are here, so that's good. At least we know we're going to have a program tonight.
If everybody wants, while we're waiting another minute to get started, feel free to type your name into the chat area and just a little bit about yourself, maybe what real estate investment strategy you focus on, where you're located, things like that. Just so everyone...
I misspelled my one. I had to have. I know I did.
Yeah, you probably did. All right, I'm going to continue to let people in as we're talking. Ian, if you don't mind monitoring some of the chat, if anybody has questions. I think everyone's automatically on mute right now. We'll make sure we can unmute everybody as needed. Questions, comments, things like that. The topics, first deal stories. Just a little bit about, we have a few people identified already. Some of the meetup members. We have a few people identified already that are just going to spend just a few minutes sharing their startup story, a little bit about the first deal that they ever did, how they found the deal, how they financed the deal, how they managed the project, some big takeaways that they got from the project, one big mistake that they made, and what the outcome of that current project was. We try to diversify it into a bunch of different asset classes between single family rentals, some flips, self-storage, Airbnb. So it'll be fun. These are topics like this, I think, are very, very interesting for everybody. So, we all come from different places, different backgrounds. We all have different experience and different real estate strategies. If you don't know me, my name is Jason Balin from Hard Money Bankers. I run this meetup group with my business partner, Chris Haddon, and then Ian Horowitz and his business partner, Dan, are also involved in this meetup group. And we've been doing it for a long time, close to about 10 years. We used to be at a local restaurant in Columbia, Maryland. And, ever since the pandemic, we've been trying to be as religious as we could and try to keep these things regularly the third Wednesday every month. I'm doing them virtually, and virtually is obviously a little bit harder because they're not as interactive. So we've been trying to come up with topics and presentations to make it more interactive. So if this is your first time tuning in, welcome. Glad you're here. Feel free, if you're just hopping on right now, feel free to add your name and where you're from, maybe your real estate strategy that you like to focus on in the comments, and we'll go from there. Feel free to keep your camera on if you want. Everyone's, I think, muted by default, but as we go, we need to unmute people. We're happy to. So feel free to you can raise your hand inside the Zoom platform, or if you want, you can, there's a chat box as well. So Ian, anything to add? Should we get started with?
No, I think we should jump right into it. I'm monitoring questions over on Facebook. You guys want to put any questions in the chat for our guest speakers as they come on? And then if there's some opportunity at the end, if anyone in the group feels like they want to share their first deal story and could help somebody, absolutely glad to have you on. Just put something in the comments. We'll get to you. Or if not, we'll probably do a little panel Q&A at the end if we have time for it. So
yeah,
I think we should. Was that?
Yeah, good question. If you have a good first deal story that you think the group can benefit for, just email me directly, jason@hardmoneybankers.com, and as we're going through these, I can go through them, and if we have time at the end, we can certainly add those.
Yeah, and I think we should just jump right into it. And I'm glad that at the last second, there's a few people on here that bailed me out because we had someone drop out. But I'd like to introduce John Farling. He's become a very close friend. We were just out in Phoenix together. Give a shout out to Terry Royce, who broke his collarbone. Hope you're feeling better, buddy. I think he's got to get a plate in his arm. For those of you that used to always come to the meetups in person, Terry was usually leading the charge at the bar. But either way, John, I want to bring you in, and if you want to go over what was I know you're in self-storage now, but what was the first deal that you ever did?
Yeah, appreciate you guys having me on. My first deal was a single family rental. I can talk about that, but it's not nearly as exciting as my first storage deal. So you guys tell me what I should talk about.
Let's start with your single family rental, and then maybe we'll go to the storage as well. Just because as your first, when you started storage, you had some experience at least in real estate, right? But when you did your first rental deal, you did not. So maybe let's talk about how you found that deal, maybe how you financed it. We'll start with that.
Yeah, it's actually they'll kind of segue into each other, but it was on the market 2004, end of 2014. Reason I did it was because we had our first kid, and knew I needed to figure out how to pay for all of our futures, and figure real estate was a good way to go. So found it on the market. It was listed. 2014 was, you were still in the recession at that point. So it was, I'd say C+ neighborhood, A+ area of town. It was a suburb of Columbus. Bought it for $70,000. Used a bank loan, 20% down. That 20% down was money from our Heloc off our personal residence. I did 98% of the work myself. Took me about 4 months to rehab. It was 900 square feet, 3-bedroom, 1-bath, real basic home. Actually just sold it about a year and a half ago. And made, what I sell it for, 150, I think. So I was all in about, we'll call it 85, and we'll call it 4 or 5 years later, sold it for about 150.
What was one big mistake that you made with that property?
Me doing everything. I did the flooring, the painting, the cabinets. I literally did everything. It's a huge mistake. I was over there. Fortunately, I had a job that allowed me to have flexibility. So I was over there by lunchtime every single day. Obviously that's not a good way to ramp up at all. I did one rental a year, and that's why, because I did majority of the rehabs myself.
What's one kind of big takeaway that you got, that like a good life lesson that you got in?
Yeah, scaling is the way to go eventually. So I had 4 single family rentals, sold all those and traded them in for self-storage facilities. So kind of like Monopoly, taking the green houses to red motels.
Yeah, me and Jason talk about that a lot. When you first get into your first deal, a lot of people are like, oh, I'm going to do single family forever, or I'm going to own 1,000 houses. And then you quickly realize potentially you can scale in other ways. And, you should always, whether you stay in single family or go to commercial, you should always be looking to trade up assets. Just because you start with a Class B or Class C property, that's okay. Cut your teeth, lower your risk. And once you've lowered that risk and you've learned what you need to learn, yeah, absolutely, trade up. And one last question for you, John, because I know you got to run unless you're sticking around for the panel. But do you think you could have done your storage deal without doing a single family prior to that?
Definitely helped. I had, just from dealing with renters, I did property management myself. Dealing with renters kind of calloused me to issues that I have with storage renters now. So yeah, it definitely helped me. I learned systems, I learned all that stuff. So yeah, it definitely helped me. Could I have done storage without it? I'm sure I would have fumbled my way through it, but it absolutely helped me.
Yeah, definitely. We, it's another thing that we talk about a lot. And we got a lot of different investors on here. We're bringing on someone later that first deal they did was a decent sized storage deal, or the next person's an Airbnb. I think now, 2014 to today, there's so much more information on the internet that you can do a lot more with a lot less. And I think that takes you a much further as well. So.
Yeah. I learned 95% of everything I've learned through Bigger Pockets. I mean, just listening to their podcast was a great education. That's really what got me going.
And the other 5% was in Phoenix this past weekend.
That was about, 0.1. Yeah. 1%.
4.9 of that was not to fall off your four-wheeler. So,
right. Don't run into things.
Guys, if you want to find John, John, are you able to stick around or you got to run?
I do have to run unless you have a few more questions.
We're good. Do your thing. If you want to chat your info in the bottom, feel free.
Yeah, appreciate it.
Ian, let's shoot to Aaron Foster right now.
Yeah, Aaron's at work.
Aaron, I'm going to unmute you if I can find you here on Zoom. Aaron, we turn your camera on if it's not on already, because I don't see you popping up. There you are.
Real quick, I was told to spice this up. So if anyone out there is having a drink while we're doing this, because we used to have a lot of drinks while we were doing this, I got some Sagamore spirits. I'm enjoying this tonight. If anyone else is having a drink, cheers. And let's bring on Aaron Foster, wherever you are, because I know you're working.
What's up, Aaron?
Hey guys, rub it in, Ian. Thanks, I appreciate that. Zach, I see a Baltimore. Yeah, I see the beard too, buddy. My name's Aaron Foster. I've been investing for about 20 years. Bought my first deal in College Park, Maryland, when I was in my early 20s. I got stuck holding the bag in 2007. I bought the house for $253. The top of the market was probably worth about $390. At the bottom of the market is probably in the 150s, but the house across the street from mine sold at auction for 110. So I had to reevaluate my game plan for investing. I ended up making it a room rental. It was 10 minutes from the metro and 10 minutes from the University of Maryland. So I got into house hacking before house hacking was even a thing, apparently. And then I started getting into liens and then long-term investments, short-term rentals. I've had properties from 5 minutes away from the western side of Maryland to 5 minutes away from the eastern side of Maryland. We got properties in Deep Creek, West Virginia, Frederick, Montgomery, or not Montgomery anymore, PG, Charles, and Wacomico.
We got your whole Wikipedia. How'd you do your first deal? Where was your first deal? What was it?
All right, first deal was in College Park, Maryland. It was a single family house, 4-bed, 2-bath. It was a renovation. And most of the stuff I did myself just because I grew up handy. I'm a blue collar worker. So kind of like John just said, like 98% of the stuff that got done was by my hands.
So did you buy it to fix and flip, or did you buy it to make it a rental property?
I bought it to make it a fix and flip, but I got stuck holding it because of the market crash in 07, 08. So I ended up making it into a long-term rental. I actually sold it about a year ago for a nice little profit.
How did you finance that first deal, or where'd the money come from?
Back then, you can get 100% or 3.5% down financing. So I just got traditional conventional financing on that one.
And what about the gap? What about the difference between the down payment and closing costs? Did you use your own cash for that?
Cash, yeah, savings.
Savings.
And then same thing for renovations. Since I can save so much money on doing my own renovations, I ended up not having to pay a lot of contractors. So it saved me a ton of money.
Got it. We got the first two so far have got traditional financing and then used either a Heloc or their own funds to cover the difference. And it's similar because back then and right now, you can get high leverage on some of these things, especially if it's one of your first deals and you do it through traditional means. You can get low down payment money. That doesn't mean you're not going to have to finance your own closing costs and construction costs, but there's traditional means to do so.
There's still 100% financing available out there. Like a lot of people just don't realize the USDA and the VA offer 100% financing if you're in the military or rural areas. So there's still opportunity there.
What was like one big mistake you made on that first deal?
One big mistake.
You came back for more.
Yeah. Not knowing, not paying attention to the taxes. So a lot of times when you buy a house, you see what the taxes are advertised at. Then once you buy it, it might change. And they might have, they have it be reassessed every couple of years. So obviously in PG County, it's one of the higher tax bracket counties in the state. I ended up getting stuck with higher taxes. I think I just paid on a similar property, something like $5,500 a year for that and $7,200 for another one.
Yeah, PG's high in general. Baltimore City's high in general, in Maryland as well. What did you say how you found that deal? I don't know if you said that.
So that was MLS. That was back when you could pick a deal off a tree. That was just MLS. I had somebody bring it up to me. The first property I wanted to get into was going to be a single family house. So that was one of the affordable areas. I wanted to have amenities near me, shopping, grocery, school, in case there was something that had a downturn. I wanted to make sure I could fall back on it. I wanted to be a primary location and not a secondary.
Hey, real quick, was it a Class C or B property?
I would say College Park is I would probably say a low B, high C.
Right.
It depends on
And
what part you're
Lauren,
in.
do you mind taking 2 seconds? Lauren, I think, Lauren was asking, what's the difference between Class A, B, and C type properties, like just in real general terms?
The amenities you have, the quality of the workmanship, the size of the houses, the what you get in the neighborhoods. If it's not, gated communities are like your Class A's, and war zones are your Class D, E, F's. C and B are your blue class working neighborhoods usually, and it depends on what amenities you have that come along with it.
Hey, before the gong goes off and we lose you here, I mean, I've been getting sleep-ins recently. I just want to let you know. But why'd you decide on what was the need, or what caused you to get into real estate investing? I mean, obviously you got a great job. Thank you for working for the DC Fire Department, protecting whoever's down there. But with that being said, why'd you get into real estate investing? What was your driving force?
So when I was a kid, we had a property. We lived in Wheaton, a real small World War II house, 2-bed, 1-bath with a flooding basement. And then when my grandparents died, we ended up inheriting a house, and I moved to that house in Rockville. And I understood at a young age that if you owned a property, somebody would pay you to live there. So I was like, okay, that makes sense. And then you just have to learn the ins and outs of the rest of it. What's your PITI, what's your renovation costs, what's your sales costs, your holding costs. And then I was like, okay, I can backdoor this and see I can make this much money a month. And obviously real estate made more millionaires than any other industry in the history of the country and probably the world. Yeah,
it's definitely if you don't understand stocks, I think real estate's probably one of the best asset classes you can get in. Hey, Aaron, for everybody that's a first responder on here, you want to share that Facebook group that you're an admin of that's been dropping killer information recently before we let you go?
Yeah, sure. So Mike Webb, he was on Bigger Pockets probably about a month ago. He was on promoting the not for Fit for Fire. What is it? First responder financial freedom. And basically it's just for first responders who want to go on there and learn other ways that there's your butt in the seat is worth more than just a 25, 35, $45 an hour. And just realize that there's passive income that can be made by investing in other things. So join the group. I drop a lot of information on there. I admin the DC one too, but there's I don't drop as much information on there just because it's very that's very narrowed down to my department. So if you guys want to join on First Responder Financial Freedom, then it's a great asset for you guys.
Hey, do you mind before you go, if you could put that in the chat? It's on Facebook, Ronald. And either myself or Aaron will get that into the chat. And Aaron, I know that we might lose you, but if we do the panel at the end, if you want to stick around, or if you want to put your info in the chat where people can find you.
Yeah, I'll hop on and off if I need to get off.
All right, brother, we appreciate it. I guess the next person we're going to bring in, who is my most recent business partner, I'm super excited for, is my business partner's sister on top of that. So I got a full family affair on my hands. But she's a realtor in Philadelphia. She literally just bought her first property. So we're going to hear her whole experience. Caitlin, you want to introduce yourself?
Hey, I'm Caitlin. I am a realtor here in North Wales, right outside of Philadelphia. And yeah, I just bought our first property with Daniel and Ian, and we turn it into an Airbnb.
And we just had our first rental this weekend. It's been quite the experience. So we
5-star review. 5-star review.
Yeah, I'm learning all about Airbnbs here in a very quick period of time. So Caitlin, what was so you're doing a short-term rental, and just so everybody knows, she prompted us on it. We didn't prompt her. We weren't like, hey, let's go buy an Airbnb. She brought us the idea. Why do you think the Airbnb would be a good investment?
Well, just for that specific property, it was a little bit of a difficult sale I had it listing, it was one of my listings, and the sellers wanted a higher price for it, even though I advised them against it. So in the hottest real estate market ever, it sat on the market for about 2 weeks, which is super long these days. So it sat there. A lot of the feedback we were getting is the rooms were a lot smaller and people just didn't see themselves living there for a long period of time, just because the bathroom's smaller, the bedrooms are smaller, the basement's not ideal. So yeah, I went to Daniel and Ian and we talked about doing it as an Airbnb, and it's been booking up. So I guess people don't really mind the smaller bedrooms as an Airbnb, just long term stuff.
Is there a reason that you decided, like when you looked at the house, it could have been a residential rental. Like what attracted you to the Airbnb? Was it because you could, actually get to decorate it, because you could market for it? Like what drew you to Airbnb versus just a standard rental property?
I mean, when you look at the numbers for the standard rental, you could rent it out for maybe $2,000 a month, where if we rented it out at full capacity, it's $6,000 a month. So, and that's just at our base rent. So obviously the numbers kind of speak for themselves, and you can always just go back to renting it and get a year-long lease in there if we fail at an Airbnb. But I mean, $6,000 a month sounds pretty nice to at least try.
Yeah, and we and I'll help you out here. One of the things we looked at was there was no inventory on Airbnb or VRBO. And it's also got some good economic drivers, not only colleges, but there's some other businesses there that people travel a lot for. I think Jason's got a question for you.
Yeah.
A few quick questions on this. How did you guys finance this one?
Oh, Ian.
Yeah, told her if you don't know the answer, just blame it on me. No, we found one of our private investors, and they fully funded it for us on a.
All right, so you got a private investor that financed the whole thing.
Yep.
We talked about how you found it.
What was your biggest learning lesson in this
well,
first deal?
Well, I was going to say, do you have any big mistakes yet? I know this is the first deal. I mean, the pros of this one compared to the other ones is a lot. The other two people that we asked, they bought properties 10 years ago and it was a much different buying environment. Now you're in a more competitive buying environment, but you might not know what your biggest mistake is yet because it might not have been made yet. But have you guys made kind of a big mistake so far?
Yeah.
Learning experience? Okay, good.
I can tell you. Well, I mean, when your brother's trying to be a cheap ass, maybe you should talk him out of it a little bit more. So
that's a good one.
We hired the wrong contractor trying to save a few bucks. He ended up creating more work for us than actually getting done work, and some of the work's not even done yet. So we had a timeline, and we could have easily just extended it more and maybe just canceled the first weekend. But I mean, the place was pretty much ready to go, and we can rent it out just the way it is. It's just not the way we wanted it. So
what recommendations would you have for investors that want to do Airbnb related to like geographic areas? Like, is this in an area that it's like, yeah, there's a lot of people, like people want to stay here, but there's no hotels or there's no housing. I mean, do you buy an Airbnb anywhere, or is it, strategic?
I mean, so there is a website called AirDNA, and it's pretty much your comps for Airbnb. I mean, we went with North Wales because I can literally see the house from my front yard. So if I'm taking care of it, I'm doing the legwork for it. So it's just easier for me. But a lot of people are questioning, why North Wales? Well, we have Merck here. So hopefully we're going to start marketing to them. And there's a few apartment complexes and hotels around us that have furnished places just for more Merck employees to come in and stay there short term. So why not offer them a nice furnished single residential home other than a hotel room. We've also had a few insurance companies reach out to us for displaced families, and a few month-long ones as well. And then for all the weekend bookings, it's mostly just people visiting family for different events.
Yeah, actually, I thought that was really interesting, and I can add some color to this that I don't think either of us ever expected to get insurance companies, and that's actually a really interesting niche market to potentially go after for Airbnbs if you're not leasing up. I was really surprised by that one, and it was what was it, like a family of 4 or 5, and they couldn't live in a hotel, so that's why they were looking at Airbnbs because of the school district and what was local to them. So that was really interesting.
Yeah.
Hold on, I thought I saw one more question. So someone was asking about AirDNA. Yes, that's where you can go and find comps. And what was the most recent thing you found about dynamic pricing? Because we're actually kind of running a quasi hotel. So if we can get flex pricing on the weekend nights, we need to make all of our money in one weekend. What was that service called?
That's called Price Labs. It's $10 a month.
Price Lab. So it flexes your prices on the weekends, weekdays, holidays, whatever it may be, and gives you dynamic pricing. Like someone just leased it for a weekend, and we were renting at like what, $250 a night, and we wound up getting like $490 a night average or something crazy like that for a 3-day stay. So
it does all of the adjusting for you. So all the hard work, and it'll break it down from each day, the time of year, if there's holidays and everything. So it does all the pricing out for you.
Let me ask you this, since you're my business partner on this. We've bought it, we've quasi put it back together, we decorated it, and we've had our first rental. Would you do it again?
Doing it this weekend.
Yeah.
Oh, you mean like renting it or another Airbnb?
Would you try to find like your experience so far, would you want to try to find another deal?
Yeah, I want at least 3 by the end of next year. Right.
All right, there we go. I got my work cut out for me.
Yeah,
Sweet.
just keep funding it. Thanks.
Caitlin, do you want to leave your contact information and even a link to our Airbnb in case anyone's up that way, or they just want to see what we did with the house and what it looks like and what the listing looks like? Because the information in the listing is one of the most important things you can do.
Yep, I'll do that.
Ian, will banks finance Airbnbs? I know some of the institutional backed hard money lenders have products for it.
I think our next guest can give us a pretty good answer to that. My gut feeling is yes. I think is Pete Belden coming on next? He could probably fill in some color on that and then talk about his first deal.
Was Pete's first deal Airbnb?
No, actually, Pete's got a really interesting story on what his first
Pete,
deal was.
Pete, I can't see you, so if you can turn your
on
there,
page 3 or
there
4.
you are. What do you got? Ian in your back? You got Ian in your background? Okay, there you are.
Is that what he did?
Look at this.
All right, Pete, go ahead.
I got to go to presenter mode so I can
Hey, I had to be I was multitasking a little bit, although I was listening to Caitlin as she was talking about Airbnb. So
Come on, man. What is this? Thanks, buddy.
All right, Pete, tell us about your first deal.
Okay. So I lived down in Baltimore City for, since 2003 in Federal Hill. And the first house that I owned, I moved out of that, moved up the street, and ended up renting that house out. And I was making $500-600 a month off of that property. And I was like, wow, this is pretty good. Definitely want to get into more rentals. Didn't have a ton of cash at the time. So my strategy was to flip a couple of houses and then, use that cash to buy some more rentals with the ultimate goal of getting out of the corporate world. So I'll say that the first real deal that I did was back in 2015. It was a property in Highlandtown. Ended up looking actually on Craigslist I just jumped on Craigslist and typed in Baltimore investment properties. And there was a few listings that came up. Actually, there was one for Canton, and that property had just been sold. But the individual I got connected with, which is a local former wholesaler in the Baltimore area, Terry Royce, And he said, hey, look, we just sold this property in Canton, but we have another one we just got under contract. So, basically did a little bit of intel on Terry. He's a wholesaler. We had some common friends. So I was like, all right, this guy's he must be legit, and ended up getting that property under contract for like 67,000, I think it was. Did a major renovation. So, put like $150,000 into it. And then I sold it for like 280. So it was going back and looking at the numbers. I was like, had a little bit of some nightmares in terms of like that whole process. And, Jason, you were talking about, what did you learn from the process and what are some mistakes that you had? And I would say I kind of went all in a little bit too fast. Doing a renovation of basically we're down to the 2 sidewalls, and everything was redone in the house completely. It was a row house. And, being a newbie and not having all of the contacts that I have like today. And, that's something that I definitely would not recommend doing. If you're going to be getting into this and you're doing your first flip, I would highly recommend, more of a cosmetic type renovation as opposed to a full-fledged, like full gut renovation, which is what I ended up doing. Held the property way too long. That's another mistake. And I should say that I used hard money for this property before I knew you, Jason, obviously. And that's the other thing is like, back then there probably weren't as many hard money lenders as there are now, but I had this mindset that I needed to quickly get into things and take action. And I probably should have done a little bit more due diligence around finding other hard money lenders in the area. I ended up using a company called Lima One Capital, which is kind of a national company at this point. And they had higher rates, and I probably could have gotten, higher points that they charged. And then, I held the property for 10 months, which that basically can make or break a deal. So,
well, and I think that's the advantage to using someone who's local, right? Like a hard money lender that's local that potentially has a little bit higher rate than what Lima One is. Don't always price shop. Sometimes you need someone with local knowledge. Let's ask you like this, Pete. If you borrowed money from Jason and Lima One probably gave you some crazy loan, but if Jason was like, "Hey man, you need to bring $100,000 to the table," because he's viewing it and saying, "Well, I know this local market, it's not a good deal." Would you have done that deal?
Well, I mean, at the time, obviously, if it was somebody that was local that didn't recommend doing the deal, I probably wouldn't have done it. But I didn't have that conversation with the local lender. The local lender took advantage, or the lender that I used ended up kind of taking advantage of me a little bit, I would say. I probably wouldn't have done the deal because they probably were like, "Okay, what's your experience?" A lot of hard money lenders, I know Jason would probably take a look at something where, the scope of work was $150,000, and they're probably like, "Okay, how many deals have you done? This is a pretty serious project." And he probably would advise against it. So that would have certainly, probably shut down that deal at that point.
What would you say the outcome of the deal was? Did you make money on it?
I probably broke, and I may have lost, I may have won, I may have made like 10 grand off the deal, honestly, for 10 months worth of work. I will say, I mean, with every deal that you do, you learn something new, and you're only going to be learning something if you take action. So for anybody that is out there that hasn't done a deal, you need to take action. But, I met Ian, I met Terry, I met all of you guys on the, Ian, Jason and everybody else from that deal because Terry connected me to you all. So to me, if you would have asked me today, would I do that deal? I would say yes, because the amount of contacts that I made and the amount of experience I got from it was tremendous, but I didn't make any money off of it.
Yeah, that's a very valid point. And, I think a lot of people are always looking for a home run, quick hit, especially with wholesaling or flipping. I think the biggest thing is taking the first step, right? Like, and you definitely did that. And I'll give you credit because I want to get into how you decided to get into rental properties. And what you did to figure that out. Before we do that, excuse me for not good name pronunciation, but Thanga was asking what are you all doing for your first flip? Do you hire a contractor, or do you full reno with getting some did you sub it all out, or did you just get a GC on your first deal? I think is the question.
The contractor that I used actually had done some work on my personal house, and had done a fair amount of full gut renovations. So I felt pretty comfortable going into the process with that person. So he was essentially like a GC is what he was.
Right. So he handled the HVAC and everything else. And
yeah,
there's a lot of, because you work a full-time W-2 corporate job, right?
Yep.
Yeah. And I think there's a lot of validity to people wanting to go with a contractor, but you're going to pay more for them handling all the headaches, right?
Yes.
Yeah. So your first flip didn't go very well. You had a lot of drinks over that deal.
Yeah.
So you decided to switch into rental real estate. Why'd you do that? And how did you source your first deal?
So I quickly realized that you didn't have to have a boatload of capital to get into rental real estate, rental properties. I'm sure a lot of folks have heard of the Burr strategy. And so, after educating myself and talking to local investors, I realized that I, could basically put a little bit of money down, renovate a house, and potentially get all that money back and, repeat the process. So the next rental property that I bought was it was a foreclosure. So I bought it on the MLS. It was a property in Baltimore County. And it wasn't $160,000 renovation or $150,000 renovation. It was I think I bought it for 70. No, I bought it for 60,000 and I put about 30,000 into it, and it appraised for $165. So I may be getting a little bit ahead of
okay, let's stop there. How'd you know to buy that house in Baltimore County?
How did I know?
Yeah, what led you to that? Obviously you spent a lot of time with me and Dan and Gary and
at that point I don't even know how much I actually knew you guys at that point, but I used a local realtor that was an investment, focused more on the investment side, and I said, hey, what are the good for Baltimore County? Because I didn't want to be in Baltimore City at the time. Still really don't want to be in Baltimore City, but and so they set up a bunch of searches in different areas, and I would get emails like, hey, this is coming on the market. Do you want to put an offer in? And I probably went through about 7 or 8 offers before I ended up getting my first one.
Right. And it just so happened that we have some rental properties there that made you feel a little more comfortable, and you utilized your network, right?
Yeah. You're probably, I think you are right. I think, that was an area where you already had 3 properties, and I kind of bounced.
That's the story I tell everyone about you. I'm like, I give Pete credit. He stalked us and figured out where we were working, and he bought houses right there. I mean, it's
there you go.
No brainer. So, no, you've really impressed me, man, of where you've come. Just so everyone knows, Pete doesn't ever get on these things, so we got him cornered. So we're gonna blitz fire him with some questions. What do you got, Jason?
What do you mean, man? I'm always on these. I back when you were having the daily podcasts during COVID, I was your only responder.
I know. We could get you. You could always watch, but you would never come on and present. So we're happy.
I had to show your pick, dude.
What? Yeah, I don't have anything else for Pete. What? Real quick on your Airbnbs. How many Airbnbs do you own, and do you manage them all yourself?
Yeah, I have 5 Airbnbs. So that's actually been it. That morphed into a whole side of the business that really is like the bulk of my real estate investment world, to be honest with you. And it's been fun, having conversation with Dan and Ian and Caitlin about the property that they just bought. I started probably 4 years ago, and every property is located less than a half mile from my house. And, they're going bananas, to be honest with you.
Yeah, and let's talk about that strategy behind that. Is that because you want them close, to keep an eye on them,
Yeah,
or is that an area that people are attracted to staying at?
Yeah, I think not everyone, but anybody that does a good amount of business in Airbnb says that you want to be near a tourist attraction, businesses, or hospitals, right? So I live in the Towson area, and there's tons of, there's St. Joe's, there's GBMC, and the other thing is colleges. So, there's Loyola University, Towson, Stevenson, Goucher, certainly lots of businesses as well. So, that piece of the business has been great, but one of the advantages is, for me, self-managing it myself is it's a half mile. They're all a half mile from my house, and all 5 properties are within a quarter mile of one another. So it's been great.
Would you, or is there anything unique about these properties, or they kind of a dime a dozen? Like if there was whatever, 3 more properties that, number one, you had the financing or the capital for, the bandwidth to deal with it, and you felt like you're getting good value for it, would you just buy it?
Yeah, if you look at the first one that I bought, the price point that I bought it at was compared to the last one that I bought. Like any other person that was buying the last property that I bought would have been like, you're crazy. Like, why are you spending that much money on a rental property? But I knew the returns that I was getting on the other 2 that I already, or the other 3 that I already had set up. So it's actually 3 separate properties, and then 2 of them are 2 units. So I was able to really profitize those 2 properties because, I have, a side by side kind of like duplex, and then a top and bottom residential house.
Yeah, I know we had looked at the one to buy it as a rental property, just as a single family rental, passed on it, and then actually Pete came behind us and wound up buying it for an Airbnb, and is absolutely crushing it. So I know I wouldn't be in the Airbnb business without the guy. So just like he followed me around, I watched his success, and now I get to follow in his success with some Airbnbs. So Pete, we appreciate you. If you want to leave your contact information and any of your Airbnb links or where people can find you in the chat, we appreciate you jumping on. If you're going to stick around, we might have a little panel at the end of this. But I want to bring in, well, I'm sure you want to say something before I get rid of you.
Thanks, buddy.
But before we get rid of Pete, I want to bring in Shane Chapin. He's become a friend. Just spent the past weekend with him in Phoenix at a self-storage mastermind. I literally watched that guy in Charlotte about a year and a half ago go to one event, and he said real estate's for me. Quit his job 6 months later after buying his first storage deal. Moved to Florida, and the man's living his best life. So Shane, where you at?
Yeah, man, right here. Here I am. I appreciate you guys having me on. Thank you so much. How you doing, Jason? Good to see you, man.
You too.
So Shane, I know storage wasn't your first deal. So before we jump into storage, you want to spend 2 seconds talking about your first real estate deal you ever did, and then we'll figure out how you ended up in storage?
Yeah, first real estate deal wasn't real exciting, but I think a lot of people follow the same trajectory. It was a single family home. Had bought it as a rental, was listening to Bigger Pockets, wanted to do the Burr strategy. It was $64,000 when we bought it, did conventional financing, used my money down, did all the rehab ourselves. It took a year to bring this thing around. It was 3-bed, 1 bath. We turned it into a 4-bed, 2-bath. Thought it was a pretty good location as far as to expressways and to get to local businesses. Ended up renting it out for about 8 months. And then my buddy that worked at the dealership with me needed a house. So I decided to pull the trigger. New York State Tenant Protection Act had just come out in 2019. And I saw a bunch of guys at the RIA just kind of panicking. Weren't sure what they were going to do with their huge portfolios. And here I just had this one house. So that was the reason that I kind of got in and out of this, and needed to look for something that I could scale, and wanted to look commercial, and ended up led down to self-storage.
Nice. Yeah. So there were some laws that were coming out that basically squeezed you, or you felt you were getting squeezed out of the single family market. You were a sales manager at a Ford dealership, correct?
Correct. Yep.
By the way, nice hat, I think. You got a nice hat on there. Yeah, I thought so. But anyway, so whatchamacallit, so you're working at the dealership and you come across self-storage through another guy's event. What drew you to self-storage?
In talking to one of the guys I know, Scott Spear, I just mentioned, that I really think commercial is the way to go. And I started going to some apartment building meetups, and looking at, strip malls, things like that. Just, I felt like single family, after all that work, was cash flowing, $350, $400 a month. And I just kind of instantly knew that was not going to get me where I wanted to go as fast as I wanted to get there. It took a lot of capital. I financed all the rehab myself, probably $45,000 just in cash, credit cards. And somebody just said, hey, have you ever thought of self-storage? I said, I've never even rented self-storage. So no, I have no idea. And ended up just, kind of reaching out to this other guy, Mike Wagner, and found self-storage, and it seemed like it had all the answers to the questions I had at that point.
Yeah, yeah, I see you're growing your hair out. So anyone that knows Mike, you'll see what I'm talking about. That being said, what'd your first storage deal look like?
First storage deal is 10,250 square feet, 78 units, pretty small. At the time, I was living in upstate New York, and this is in South Carolina, so it was about 850 miles away. It was brought to me by a wholesaler that was in this group that knew I was looking for my first deal. Joined this group in probably April of 2020. I still had the single family house, and I ended up under contract in June of 2020 for this first facility. So it happened pretty quick. It really didn't. I really didn't know what I was doing too much, but that was one of the biggest lessons I learned is just not to expect to know everything, or you won't do anything. It's at the time it was grossing $1,500 a month, about 20% occupied. The owner did not have the power turned on. There was a gate, but the gate didn't work. Again, no power. He was collecting pretty much money if he saw somebody in the grocery store, like, hey, I think you owe me $50. It was kind of like that. He just had no interest. We paid $210,000 for the facility when we bought it.
Paid about $21 a foot on 10,000 square feet, which for guys in here, we're gonna get a little lesson on storage, which is a really, really good price, and it's very hard to replicate nowadays. How'd you finance that first deal?
Cash. I raised money from two private lenders. I partnered up with a couple of guys, and they brought the money for that.
Did the wholesaler roll his fee into this deal? Is that one?
Yeah, he did. Yeah. So one of the wholesalers actually took his fee and then rolled it right back in as pretty much as a 10% partner on the deal.
So as an equity contribution. So you found a private lender, and then
Yes.
you got the wholesaler to leave his fee into the deal and retain 10% equity.
Correct.
And you had no money in this deal.
Zero.
And you didn't finance it. Did 100% finance through private investors.
100% financed through private investors, including the rehab.
That's pretty impressive. So what would you say your number one learning lesson on this first deal was?
Honestly, just to do it. I had no business buying this facility 850 miles away, being my first one. It was not up and functioning. It needed a lot of work. So to manage that from such a distance was difficult. But if you're asking me that now in hindsight, I wouldn't change anything because it all seemed to work out so well. So I'm just glad that I did it. Glad that I took the action that I needed to take. Wasn't afraid of what I didn't know, and I trusted the network that I had plugged into to be there for me if things went sideways.
Yeah. Before we highlight your latest deal, which I want to give you some praise on, Jay, what other questions we got?
What you still own that property? I'm trying to figure.
Yes, I do.
What was so the outcome of it was a positive one. It cash flows and somewhat hands off, I would guess.
Sure. Yeah. Gross income monthly was like $1,500 a month. We're at like $5,500 a month now. That's 13 months later.
That's awesome.
That was our 23-month projection, and so we've kind of hit that, almost a year ahead of time. So we're doing okay.
Yeah, and you guys are getting ready for an expansion there too, correct?
Correct. We're chasing some land on the other side of one of the buildings, buying it from a family that owns a KFC, and they just got some dead area back there that'll be real useful for us. So we're trying to get some room for an expansion.
Nice. Yeah. So before we jump into a panel or open this up for other people for questions, I know some of our presenters are still here in the room. So either type them over in the chat or jump on here. And if one of the presenters aren't there, we can answer them. Jason's telling me that me and him are going to give our first deal story, so we'll jump into that. But Shane, just real quick, you've really progressed since your first deal. You have retired.
I left the car business. Yeah, I was the general sales manager of a Ford franchise dealership, and I left that after sitting with you and another guy at my very first retreat that I'd ever gone to. And
ironically, I was telling you to quit your job, and I couldn't quit my job.
Yeah. You were telling me to just do it.
Yeah, just do it. Meanwhile, I'm being a wuss. And then number two, your latest deal, just so everybody knows, your second deal. And you didn't do a ton of deals in this 12-month period. You hyper concentrated on doing one deal very well, concentrating on your life. You're buying a deal in Macon, Georgia. What's that look like? How much is it? And how much capital did you raise in the last 4 weeks?
Yeah, the one in Macon, Georgia is 21,475 square feet, 150 units. This one's being managed better. This one is about 82% occupied right now. Their income is low. Rents are probably 35% below the market, and they're running close to a 60% expense ratio, which for self-storage is insane. You should be 28 to 35, somewhere in that range. Bought it for $600,000, and that's the number that I actually raised from private investors in the last 4 weeks.
And you didn't think you were going to raise the $600,000?
No, absolutely not. This was obviously the largest raise of my vast real estate career. And there was definitely times where I thought maybe I'll get halfway there, and it just kept going. So I'm still grateful and impressed.
I watched this man close it out this weekend in Phoenix. He was every morning we woke up, I said, Shane, where are you at? Shane, where are you at? And I watched him close it out in a room full of other storage investors. And raising money from other real estate investors is one of the hardest thing to do. And I watched this man close it out. So I'll give you mad props. Real quick, AJ, how many investors did you have on that $600,000? And then I'm going to interview Jason.
12.
So about 50,000 each. So that's a pretty good average. And that's about market. Shane, we appreciate you. If you want to leave your contact information over the side, if you want to stick around, if anyone has any other questions, we'll bring them on, have you answer them. And now we get to hear.
Hey, Ian, real quick, let Shane answer Dave's question, because it's a good one. At what point do you plan on buying out investors, or how long do they stay in as equity partners?
Yeah, that's a great question. So both deals, it's kind of a first round is the way I look at this. So the very first deal, the plan was 3 years. The market right now is telling me that maybe we should pull the trigger and sell this facility, but I'd like to try to at least get the land under contract that's next to it to kind of go as a package deal and give somebody some room to play. But that was a 3-year play. That was written into the operating agreement, and I did give one of my investors on that one first right of refusal. I think we're just going to sell and move the equity into something larger. As far as the Macon, Georgia, this plan is less than 24 months. We're going to be in and out of this. I don't plan on holding it. I don't plan on buying out my investors. We're just going to sell it when the time is right, and everyone's going to walk away happy and hopefully do this again on the bigger scale.
Hell yeah, man. That's awesome. So I'm just trying to beat Jason to the punch here, because I don't want him to interview me. I finally want to turn the spotlight on to Jason.
You know what? I don't think you know anything about my first deal, and I'm not sure.
I was going to say,
I don't know anything about your first deal. I'll tell you, you're going to be surprised.
I was going to say, everybody knows you as a super successful hard money lender, host of the best podcast out there. But how did you get involved in real estate? What is your first real estate deal? I've heard all the stories about you going to conferences and gurus, and I think you said you went and saw Donald Trump speak when he was doing that whole tour. Like, what was your first deal?
I think 04 or 05 was mine and my business partner Chris's deal. Every deal we've done has been together as a team before we even started Hard Money Bankers together. Surprisingly, it was in Willingboro, New Jersey. It wasn't even local to here. And until even
Yeah.
recently, I never even lended in New Jersey until we had an office up there. And the reason we did the deal up there is because we had a buddy from college who knew a little bit about real estate, probably less than us, but he still knew about real estate. He owned a home improvement company then, and we were really nervous about the construction of it. It was a fix and flip, and we were really nervous about the construction. That was one of our big things. So we teamed up with him. We got a hard money lender out of Texas, and this was back before institutional backed lenders. It was a true hard money lender, 15 and 5. So he financed a good bit of it. We had me and my partner Chris each had Helocs, not a huge Heloc, but together we pooled our Heloc money from our primaries. We each had a condo and a townhouse, and I don't know, we had a Heloc of like 20 or 30, 40 grand, something like that. And we pulled them together and we bought a property. And we bought a property in Willingboro, New Jersey. Surprisingly, I didn't even know where that was at the time.
Yeah, I surprisingly know where that is. Did you was it a flip or a rental?
It was a flip. We did 3 flips very, very quickly, and they were all in that area. And it was the same process with the hard money lender and some Heloc money.
And presumably you guys made money on that?
I think we probably broke even. I don't think we really made any money on those things. I mean, we should have, because when we purchased them, if we purchased them and, waited it out the right time period and sold it as is, we probably should have made money, but we ended up mucking it up somehow, mostly on the construction side of things. Everything went over budget.
And what was your driving force for getting into real estate? Like, why'd you guys pick fix and flips?
Money, big sums. I mean, it's just like anybody, like it's, if you don't have kind of a big piggy bank, you're like, well, I don't want to buy rentals because I want the fast path, and I don't want $300 a month. That's not going to change my life, but $30,000 in one lump sum could. Even though there's an argument that that's the wrong mindset, that was our mindset back then, and we wanted big hits. And then we felt that after we had big hits, we would turn it into, just like anything else. I'm going to buy some flips, I'm going to make some money, then I'm going to turn it into rentals, I'm going to do this, I'm going to do that. And, you don't know. You don't know what you don't know back then. And you learn very, very quickly on the job.
All right, let me ask you one more question, because I know you're going to run me through the ringer. Is you do these flips somewhere along the line, you mind sharing how you got into hard money, and what was your mind shift change that
Sure.
flipping real estate wasn't for you?
Well, the day I knew it wasn't for me was the first time I went to go see that property, because we bought it before I saw it. Because we had a partner up there who ran point on it. And I went up there with, I don't think Chris was with us, but I think it was me and my wife, who was girlfriend back then. And then we had a partner named Josh, and then his wife or girlfriend. And, we had old clothes on, and we started, taking out hammers and demoing that house. And I remember we demoed the house. We started demoing, pulling off siding and fascia soffit, stuff like that. I remember I got sick for a week afterwards. And we were all kind of hands on deck. It was cold out, and I was like, I don't want to be doing this, getting my hands dirty on some of these projects. It just wasn't, I thought, because this is also when like Flip This House came out, things like that. I'm assuming that it was like mid 2000s, and it looked a lot more notorious, it looked a lot better than it really was. We knew we didn't want to be hands-on with these, full-time hands-on, but like, I thought like, hey, let's go try it, like see how it works out. So that was that. Related to hard money bankers, about how we started a hard money lending company. Kind of an interesting story as well. I'm trying to think. I don't want to skip anything in. You got me on the spot.
Yeah, it sounds like need another drink. So you were in finance of some sort, right?
Yeah. So okay. So when I graduated college, I was a real estate agent for a while, and I really liked that. I really liked that for a short period of time, and then I worked at a mortgage company. I learned hard money through the mortgage company because it was a small company. I remember one time that we had a loan that I thought was a halfway decent loan. It was pretty well collateralized. and who they had, they were like correspondent lender, so they'd fund a loan and then they'd sell it off to another investor or secondary market or whatever. And I remember there was a deal, and the deal they couldn't get sold off, and they're like, you know what? Let's end up doing this deal. We'll just use our own money for it. And I was like, you can do that. And so they were the private lender on it. It was like a $50,000 deal in Baltimore City or something like that. And through that process of working there for a few years in early 2000s, I learned exactly how they did that. I learned the process of doing it. And I liked kind of the finance side of, hey, you can make a few points. You can kind of do this. You can help real estate investors invest in deals and, kind of partner with them alongside and make money on that. I like the finance side a lot better than the hard work real estate side. I know a lot of people are into improving a property and the real estate. I've owned over the years my fair share of rental properties and fair share of flips, and none of that came very natural to me. I like the finance side of it. So my partner Chris and I, in 2007, we were literally about to start a regular mortgage company. Like, we had the name lined up, the LLC docs filed. And, as soon as that kind of was occurring, this is like early 2007, it was right when a lot of the mortgage companies were shutting down. And we're like, yeah, maybe we shouldn't start a traditional finance company. Maybe we should start a hard money lending company, because we still own some of those flips and we were still doing some flipping at the time. And there was a guy named Ray Walter that we did. It was either 3 or 5 flips with in Texas. There's a guy in Texas charging 15 and 5. So we were like, you know what? We want to do what Ray's doing. We want to be a hard money lender. We just worked our butt off for 6 months on this flip and didn't make any money or made very little money. And he lent us $150,000 and made, whatever, $7,500 on points, because it was 15 and 5 terms back then, plus interest. And he probably made interest on us for a year because we screwed up on that deal. So he made a ton of money. We didn't. So we're like, we like this finance thing. And that's kind of how it started. We didn't have any Heloc money left at that point to use.
Yeah.
So we had to raise all private capital. Our first deal we ever did, we raised money for.
Yeah. And that's actually, it's interesting to me because you found out really quickly. I bought my first rental property and I was like, this is the best drug in the world. And off I went, right? Like, right, wrong, or indifferent. That's what worked for me. And I think for you to figure it out very early on that it's not for you, and instead of pushing and enduring through the pain, you said, okay, let's figure out a different way to do this, but still be involved in real estate.
Yeah. And come to think about it, like, as a net out of all those properties was a net loss. Like, we lost money out of all the first deal, I don't remember if we lost money or not, but after owning a bunch of properties, we pretty much lost our Heloc money for the most part. We paid off the lender, lost our Heloc money. Maybe we had some of the money left, but like, it was definitely, like, let's say we had $50,000 in like seed capital between 2 Helocs. We probably had 20 left at the end of the day. So it wasn't a positive experience at the end.
Yeah, man, definitely. Well, there you go. I see some good questions going on over in the chat. So there was someone asking Shane about his the financial side of his first deal. I thought I saw another Airbnb question.
All private money. That was the answer on that one, right? From his.
What was that?
The financial side of his deal. Oh, do you mean like what the profit margins were, or just how you found the deal?
Yeah, what the capital stack is. If you want to put that, the rest of your question in the chat, we can have Shane jump on real quick about that. If you can.
So I think I might know where your first deal in, but I'm not 100% sure. So was it one of those properties in 21213?
Yep, my first property was over in 21213. Fireman for the city of Baltimore at the time. We were working 2 10-hour days, 2 14-hour nights. We would work all day before night work our 4 days off. So basically we were working 8 days a week, nonstop. So there's got to be a better way. Came across real estate through my in-laws for someone that was coming into their shop, and he was doing subsidized rentals. And I said, oh, that's interesting. So I bought every book I could, which at the time there was only 2 books at the time. Did as much digging as I could in 2013 on the internet. I wound up at a meetup with some guy and had some drinks with him. And afterwards, he said, "Hey man, you ever need anything? Give me a shout." Followed up with him, showed me around town. A couple weeks later, he called up and said, "Hey, I got this house. You want to buy it?" Dude, I had no clue how I was going to pay for it. All I knew is I had 15 grand in the bank. The thing was, I think I bought it for 20 grand. I wound up going out and finding a hard money lender to finance the whole thing. I think they charged me 15 and 5, 15 and 6, something crazy like that. And I got a hard money loan. I scrapped it together. I was going there every day. I can't say that I did the right thing every time when it came to putting the house together, but I did it. Got it all completed, got it leased up. And when we got it leased up, I was all into that thing for maybe 50 or 60 grand. You could tell at that time I had no clue what my cost was, because we were just trying to throw money, just try to get it done. The financial side of the thing wasn't that important to me as much as just getting it up and running. And ultimately we rented that out for $1,250. My mortgage payment was like $450 a month. And I said, this is amazing. I was cash flowing, $600 to $800 a month. And, off I went. I bought another one and, just continued on. And I'll be honest with you guys, I had no clue. I mean, I literally, my credit score was sub 600 when I bought that house. I said, it'll work out. I have no clue. The universe will put me in the right direction. Got my credit up to barely where it needed to be. And I refinanced the thing in my own name, not an LLC. I refinanced it in my own name. I got like a 3.25 or some insanely low rate when I refinanced that in my personal name, and got my money back. And I did house number 2. Actually, I think I did house number 2 before I ever refinanced house number 1. Just because I said, well, I at least make as much money as I can before I lose it all. And then I wound up refinancing both of them. And it's grown what it is today. So.
Nice. You still own those properties?
No, I finally, I quasi own them through another investor who I sold them to, who we still have a partnership with. They're still technically somewhere in our portfolio, but we don't actively manage them today. So.
Nice. Cool. No further questions.
No further. That's it. I'm a boring guy. So.
Well, let's go through some of these questions real quick. And then if anyone has an individual question for somebody who's still on, we can kind of go through that real quick, just because we're going to wrap up in like 10 minutes. Kimberly asked the question, if I own a property, can I still get a hard money loan for the rehab? Yeah, it would just be like a refinance. Let's say you own the property, you bought it in cash and you just need money to fix it up. It could be a cash out refinance. That's no problem. And you can use the money for that, or for the financing. I'm sorry, use the money for the renovations. I'm trying to see what other questions stick out. Who gets what percent and how does
someone was asking what subsidized is? Subsidized rentals is basically Section 8 government backed housing. And there's a book on Amazon called Subsidized if you're interested.
Good book. So there's another question. I'm not sure who this is from. It says, I'm just going to rephrase it, but how did he decide who gets what percent and how he sold them the idea? I'm guessing this means when raising capital from private investors. I'm guessing that could be for Shane. I mean, we can answer that. I mean, raising private capital, I did it for the first 5 years. It raised, close to $40 million for all our hard money loans. And, it takes time at the beginning, but, as you're taking care of your investors, it grows very, very, very quickly, over and over and over. Obviously, you have to have good opportunities and good deals. The one thing with all high net worth individuals, or all people that want to deploy money, is they want to deploy it in a safe, stable investment with an operator that they trust. Someone that invests with me is not going to invest with you. They're not going to invest with Ian. They're not going to invest with Pete. If someone invests with Shane, they're not going to invest with me. It's all about personal, individual relationships. And I did learn this the hard way, because I thought I had to go out and raise money over and over and over. Like, I have to go raise money. And everyone I talked to was like, well, okay, sure. It sounds good. Show me a deal, show me an opportunity. So it's really about finding a really good opportunity, a really good deal. And then the investors, follow. And, how do you decide what interest rate or what percentage or what equity you give them? It's supply and demand. It's just kind of what are you willing to kind of give up to make the deal work? And, what is good? Like, could you raise capital at a 4% interest rate? Possibly. I probably wouldn't recommend it. You're not gonna bring in the right strategic investors that you're going to want to work with. You're probably going to bring in less educated, smaller increments, things like that. In my experience, a double-digit interest rate return, maybe around 10%, is typically a good benchmark on some of these things. Does that mean you can raise capital cheaper? Absolutely. But keep in mind, most capital investors that you're raising money from are high net worth individuals. By the time they pay high tax brackets, that interest rate return goes lower. So it just kind of depends on but there's no kind of going rate. A lot of, I've been involved in syndications where we put up money into those. Ian and Shane and some other folks have been on the other promoter side or the general partner side on some of those going to raise money. And what they end up doing is they put together, they put together their numbers that work for their project. They work with that, and then they go try to raise capital behind it. And, they do it on what they, what's a good amount. Am I going to give up 50% of my equity? Am I going to give up 35% of my equity? Am I going to give up low equity, but I'm going to give them a high interest rate return? So it's hard to say that there's like a rule of thumb. It's just kind of based on the overall project. I mean, in essence, a lot of capital investors, based on risk, they're looking for at least 8% or 10%. And, if it's a value add property, or if it's a property with high construction or higher risk, they potentially in the long run want to achieve something significantly higher than that. But again, it kind of goes back to supply and demand. I don't know if you want to add anything to that, Ian, before we keep moving on.
Yeah, supply and demand's a good one, as well as you need to service the investors. You're a steward of their capital. Make sure you're putting them into deals that you believe in, that you're okay with owning. Something goes sideways, you're able to take them out. I think those are very important things, and every deal is a little bit different, and every deal requires something a little bit different based on what the risk tolerance of your investors are. So what other good questions we got on? I see that you got any other good ones before we get out of here? I like this one here. Would you use a Heloc or hard money for Burr Rehab? If you use Heloc, does it make lenders hard to refinance? 9 times out of 10, no. The lender doesn't really care. They just know that they're taking out the debt. Sometimes they want you to have some equity in the deal. So remember that. Us personally, when we were growing our rental portfolio, the way we did it was I would go to Jason, I would borrow money. I would go to my buddy Shane or Caitlin and say, hey, I'm getting a loan from Jason at $100,000. I need to borrow some money to do this deal. They would lend me, say, $20,000 to do the difference. That house would be worth $150,000 or $160,000. I'd fix it up, get it rented out. I'd go to the bank, refinance it at 75%, and I'd take out Jason's loan, and then I'd pay my friends back. And that's what we did over and over and over again. That's really simple form. Sometimes we would get some money stuck in the deal. Other times we would get every single dollar back. But, you always got to look at it as a portfolio the same way you look as your stocks or your bonds or whatever your other investment vehicles are. It's a portfolio. Not every deal is going to be an infinite return, and not every deal, are you going to be able to get every single dollar back. And that's okay. Look at your overall return with the money that's stuck in the deals that you have out there.
Hey, I'm going to unmute Greg. What's up, Greg? Good to see you again. I saw you last week on a different topic podcast or a different topic.
Yeah. How you doing, man? Great little deal here. Appreciate you guys hosting this thing. Just super informative. But my question was about your business, the hard money side. You said you guys are I think, strictly doing that 13 and 3 model, right? I think that's what you guys do.
Yeah, we go a little bit lower if it's on higher loan amounts, but typically that's what it is.
Gotcha. Okay, cool. So questions about like default rates. Does that sort of necessarily, by virtue of you guys being sort of rich to the market, I would say, with capital being so cheap right now, at least in California, like there's a lot of guys who are, in that frankly, sub 10, 1 in 8, 1 in 7, for some of the bigger deal structures. Like, do you guys necessarily sort of see higher default rates as a result of that? Just by virtue of the selection of kind of the people.
When
who are
you
gonna-
say
who are
default
gonna-
rates, like meaning the
Defaulted
amount
loan.
of loans that are defaulted.
Yeah, so essentially stuff that's workout, however you guys classify. sort of
Just
non-performing in your portfolio. Yeah.
no. I mean, number one with the market right now, all the bad deals flushed out, right? Like if you had
Yeah.
a deal that because you can, it's worth 120% today than it was tomorrow, than it was, a few days. I'm sorry, than a few days
Right.
ago. So like
Yeah.
that's always flushes a lender. That always kind of flushes out. But are you saying because hey, there's institutional backed lenders at 8%, you charge 13%? Are you getting lower?
It's
end
like a
deals?
natural selection. Yeah, like it's a natural selection. Like
they're-
the smarter
they're-
capital will sort of accrete to the lower.
They're
accrete to the cheaper
different.
capital, but
I mean, they're not any less qualified
Right.
than any other ones. It's a difference of time frame, relationship, ease of capital. Ian's got the ability to go get very, very cheap capital. I mean, he's raised a lot of money, and there's deals that'd be like, hey, I forgot I just bought this property. I need to close, in 3 days or 4 days or 5 days. Can you do it? Yeah, sure. So a lot of it's that. I mean, if you do, you do the math on some of these deals, and I know in California your loan amounts might be larger, but like, let's say you go to a Lima 1 and they're 8.99 or 9.99 rate,
Yeah.
and we're 13% on a $100,000 loan or $200,000 loan, and they only need the money for 3 months. Like if you do the math, it's not much different.
No, the
money
delta's
wise,
small,
and
yeah.
I mean, we do a lot of business with real estate investors that need to move quick. They'll go through the institutional model, then and if they can get that, that's great. They should. It's cheaper capital. If they can do it with less headaches. But a lot of folks can't deal with those headaches, right? Like they got to get an appraisal. It's going to take 3 weeks. They're backed up.
Yeah, more of an institutional process.
Whatever the case is. If we're second in line, it's fine. I mean, I work with a lot of real estate investors that do 40 deals a year, and I do 4 of them or 5 of them, and they're using institutional backed lenders for the other ones. So
Sorry.
What's that? Sorry.
I was gonna say prime example is Shane, right? He is raising capital for his deal, started sweating bullets, and Jason found a way to stopgap it through a hard money loan until he can complete his capital stack. There's a lot of ways to utilize hard money. We, like Jason said, we use it all the time. We used to have a guidance line of credit with a bank. And sometimes we were maxed out. We were waiting for another deal to sell. We would just utilize Jason and say, whatever, it's 13-3. We're getting in and out. Who cares? Let's keep it moving. I'll be candid with you. Granted, it's his podcast, but it hurts every once in a while when you have access to cheaper capital. But you know what? It's a tool in the toolbox, and that's all that matters. And that's that's how we viewed it. And real quick, for everyone asking, that's what's 13-3 and 15-5. 13% is the interest rate. 3 is the points that you're paying on your loan up front at the closing table. So if you borrow $100,000, you're going to pay $13,000 a year in interest, and you're going to pay $3,000 at the closing table to get that loan.
Yeah, I wouldn't, if you're talking on the lending side that you want to lend, like as the lender, you don't negotiate on, higher leverage or worse deals or lower credit. It's still the same. And if the deals work, they work. I mean, it's just like anything else. It's a marketing game. You got to try to get as many opportunities as possible. And
lead gen, right?
Yeah. All day long, full throttle relationships, things like that. And I get it. I'll it's a very easy conversation for me to have with a real estate investor that reaches out to me for the first time. And I'll tell them straight up, and like, listen, this is what our terms are. It might not be the best fit for you. There could be a cheaper option, but if you want a very easy, quick path, I mean, there's deals that will come in on Wednesday that have to close on a Thursday. It's not ideal. I don't want to have to, divert everyone on our team to prioritize it. But if that's what you got to do, that's what you have to do. Like, we'll make it work if we need to.
Yeah, when you said cheaper capital for larger loan amounts, what does that look like in terms of deal structure, sizing, and then pricing?
11.99 and 2 if it's like a $300,000 loan.
Gotcha.
So 12 and 2.
Yep, 12 and 2. Okay. So in terms of default rate, you're saying basically, or problem loans, workout stuff, sort of industry average in hard money.
I don't know what the industry average is, but I would guess that we're significantly lower than the institutional lenders. I would guess that the institutional lenders are probably at 10%. I would guess, but I don't know that for a
And what are
fact.
you guys at?
Very little. If
Wow.
sometimes 0, sometimes 1, 2, 3. The last foreclosure, the last property we took back was in 19, I think, or maybe in early 2020.
Wow.
So but again, the market's helped.
Yeah, market's
Right
insane
now.
right now, right?
And I mean, that's just not on the lending side, that's on the buying side. I mean, some people got to have a reality check that, you know, you did your first 3, 4, 5 flips in the last 2 years. It doesn't mean the market's going to stay like this. You know, you bought it retail and you sold it for 120%. Like that's like that for of what it should have sold for. Like that's, you know, I hate to say it, but like, you know, you're gonna get punched in the tooth when you realize that's not the way that this, you know, this business works. So
Cool. Yeah, no, good stuff. I appreciate that. Really good stuff. Thanks, guys.
Absolutely.
Ian, any other good questions come in while we were?
I will say this has been one of our more active chats, so it's been very hard for me to keep up. And I was checking Facebook. I think we covered a lot. All the speakers have posted their information in the chat somewhere. We're all going to send out a follow-up email with the replay of this, along with the appropriate contact information for all the speakers. Most of them can be found on Facebook. So I appreciate the audience. Jason, we don't have any other hands up. The audience has been awesome, interactive, and we'll definitely catch you guys. We got some good special guests coming up here over the next few weeks, early November, and getting set up for next month's meeting.
So next month's November 17th, is that right? So the third Wednesday every month. That's typically when we do this. When we do this group, there is definitely people that got locked out of this one because we only have 100 participants that can come on here live. And I got notified that there was people that couldn't hop in until other people hopped out. So glad you stayed on, and, you know, feel free. You can, if you go to the Meetup group site right now, you can register for next month's. So, you know, register, you know, just so you can have all the information in front of you so you don't forget. And, topic's going to come out soon. And if anyone has any ideas for good speakers or good topics, you know, obviously nobody's selling, pitching, no gurus. It's just local real estate investors that are doing deals we can all share from. You know, the majority of the group is DC, Maryland, Virginia, and also like the Philadelphia, New Jersey area. But obviously, as we saw, there's folks from all parts of the country. So most of the speakers we do bring in are kind of local, because, you know, a lot of us can get the majority of the value from that. So if you guys need anything, feel free to reach out. My email is jason@hardmoneybankers.com. Ian's is ian@equitywarehouse.com. And if you have any ideas for future meetups, feel free to reach out.
Yeah, man. Absolutely. Appreciate everyone.
All right. Take care. Thanks.
That's it.